What are the three best ways to trade with the engulfing candle pattern? Hi, my name is Vladimir Rybakov from Traders Academy Club. If you are new to my channel, I would like to invite you to subscribe. To do so, just follow the subscribe button below and to join me in my free Telegram channel where you can find trading ideas, strategies, videos, and many more valuable things. To do so, just follow the description below or find a link in the comment section below the video. In this video, I would like to talk about the three best ways to use the engulfing candle pattern, the so famous and yet amazing candle pattern. First of all, what is the engulfing? The engulfing candlestick pattern is formed by two candles, two bars or periods, you can call it as well. The engulfing could be bullish or bearish, and the pattern is pretty easy to recognize structure. It consists of candle or a bar which gets engulfed or swallowed or eaten or just covered by the next candle on the chart. To get a valid engulfing pattern, the first candle should completely fit inside the body of the next candle. Note, the higher the time frame you will find engulfing on, the more reliable it will be. So this is how it looks like. This is called a bullish engulfing pattern. We are at a bearish move, which is finished with a red candle, which is engulfed completely by the next green candle. And a bearish engulfing candle pattern basically is the opposite. After a rally which is finished with a green candle, you get yourself a red candle which is completely engulfing or covers the previous green candle. Now, engulfing could be separated by two, full or regular, and I would like to explain the differences in between them. So the first one is this. After a move down, we got a red candle. Well, in that case it's white because I'm using a black background, but white candle for me is bearish, green candle is bullish. So you can see here the body of the candle does cover the body of the previous candle. However, the spikes or the wicks, the high and the low, do not cover the previous candle high and low. This is a regular or partial or just not full candle pattern of the engulfing, still useful. However, this is how we separate them. After the move upside, we got here a full engulfing pattern. Why? You can see the body of the white candle covers the body of the green candle, and the spikes cover the previous spikes as well, fully. Then you gotta move down, and now I want you to think, is that a regular or is that full? The answer here would be regular or not full. The idea is simple. Body covers the body, spikes do not cover the previous candle spikes. This is a move upside, and here we have a full engulfing. Spikes cover the spikes, right? That's the spikes of the green candle, that's the spikes of the white or red candle. They cover it completely, and also the body of the red candle covers the body of the green candle. Move down, and another full engulfing appears. After engulfings, we expect the market to move in the direction of the engulfing. So if that was bullish, we expect a bullish move. If that was bearish, we expect a bearish move. Bullish, bullish move, bearish, bearish, bullish, bullish. Okay, so based on the engulfing candle pattern, we basically develop our expectations to the coming move. The three best ways, from my point of view, to use the engulfing are this: created parallel to a false breakout and confirming it. I will show that in the chart in a minute. On top or bottom of channels, very powerful strategy, or my personally favorite, confirmed with divergence. Let's start with the first one, created parallel to a false breakout and confirming it. As you can see, at this area we got a high right here the market was trying to break this high, right, and failed, right? This level was broken upside and failed. Right at the end of this candle, look what happened. This became to be an engulfing, full, as it covers both spikes and the body. Okay, then we got to move down. This low was false broken. We got a breakout, and right after that we got a bullish engulfing. Again, it was full because we have body and spikes covering the previous candle. At the end of this move down, this low was false broken by a full engulfing. Both body and spikes of the green candle are covering the white candle, the red candle. Same here, move up. We have here a high, right? False break comes right here, and that's not an engulfing. This is right here. Spikes are covering the spikes of the small green candle, and the body covers it fully. Once again, the expectations are as to the direction of the engulfing. This is the first very powerful method to use. Don't try to find it on 5 minutes or 1 minute. It will be a waste of time. It's amazingly strong on the higher time frames, like the daily, weekly, sometimes even the 4-hour chart. Very, very powerful. Go and test it. The second one is the top and the bottom of the channels. Now, channels could be parallel lines, channels could be ranges, could be any kind of pattern, could be Bollinger Bands or any other band, or as I use here, just for the case of the example, envelopes. It doesn't really matter what indicator you use to create channels, as long as you have the majority of tops and bottoms covered with the channel you choose to use. That's good, this channel would be relevant to the current market conditions. So our idea is very simple. We want to see the engulfing pattern comes right at the top, or ideally even trying to false break above or out of the channel. So right here, slightly above the channel, we have this engulfing covering the previous candle pattern, right? It's full engulfing here, as again the red candle, in that case white candle, both highs and lows covering the previous highs and lows, and the body covers the body. Full coverage. We expect to move down. Right before that, we got here an engulfing, not the first two, the next two. And you got here a red candle, white in that case, and a fully coverage with the body. Not full engulfing, only body. That makes it a regular engulfing. Here we got a full one. Here we got a regular one. Right? Because we don't have the high broken with the engulfing. Here we got regular one. Here we got regular one. Here we got full one, right? Both highs, lows, and body to body. Here we got full one, and here we got full one. Okay, they all come on the boundaries of the channels. Very close to it or slightly out of it. The channel, in that case, it was envelope indicator. And once again, the expectations for the moves after such engulfings are as the direction of the engulfing. Okay, that's pretty much the importance of it. And my personal favorite style is with divergence. So if you are new to the world of the divergence, no worries. First of all, inside my channel you can watch a lot of videos explaining that, and also you can go and explore my Divergence University. And here I would like to give you the complete basics of the understanding of divergence. Divergence situation is when the market, the price, and the indicator, any indicator, I use the MACD, it could be RSI, it could be momentum, CCI, any type of such indicators. The idea is very simple. When the price and the indicator give you different picture at the end of a trend. So if you had a bullish trend, you are comparing higher highs on the chart versus the highs on the indicator, in that case the MACD. It could be both histogram or moving average or together, doesn't matter. And you would see opposite directions. Higher highs on the chart, lower highs on the indicator. That's called a bearish divergence, as the indicator hints for a move down. Here we got lower lows in a downtrend versus higher lows on the MACD. That's a hint for a reversal to the upside. Here you got a situation of a move down, double bottom, and a bullish divergence, as you have double bottom on the chart, but the lows on the MACD are showing upside. So this is the basics of the divergence, and when it comes together, for me personally, it's a sugar situation. You get yourself here a regular engulfing, not full, as we don't have highs and lows covering. Here you got also regular engulfing. Here you got a full engulfing. And all these situations, basically, we are looking to trade in the direction of the divergence and the engulfing. Personally, my favorite style. So, that's pretty much it about the best 3 ways to use the most powerful engulfing, the most powerful Japanese candlesticks pattern. There are many very powerful ones. Engulfing is always on the top few, and I love it. What I would suggest to you is go to the charts, visually practice that. Don't try to go to the low time frames. Start from the higher time frames, like daily charts, for example, or 4-hour chart. Try these combinations and you would see why it is considered to be such a powerful candle pattern and such a reliable trading style. So that's all for now. Thank you very much for watching. If you enjoyed the video, please hit the like button, drop some comment below, let me know what you think about it. And if you have any question, please don't hesitate to contact me on the website as suggested here. That's all for now. I'm Vladimir Rybakov from Traders Academy Club, and I'll see you soon with more videos. Ciao for now.